Let's shift focus away from the equity markets for a while, and we've got Fani Shankar, who's head of financial markets at ING Vaishya Bank, joining us now on the show. Fani, to begin with, just focusing on the rupee, we've seen it come under some amount of pressure over actually today. But what's the outlook? Do you believe that next week is going to spell further pressure for the rupee as OMCs come into market to buy dollars?
Well, not exactly. Rupee has been in a range for some time now. It's fairly balanced in terms of the upward and downward movements. We do not expect significant pressure on because of any one-side purchases, especially the oil marketing companies. And you know, in some ways, the BOP pressure has also eased off quite a bit on the rupee. We do think that going forward, it will be fairly neutral. So we see a range-bound situation on rupee, nothing significantly up or down.
But you would say that it would be range-bound even despite all of the fundamental factors stacking up against the rupee. Are you not? Don't you think that we're likely to see more downside pressure?
Most of it is in the price. If you look at from the macroeconomic side, whether it's the fiscal situation, the rating outlook, everything else on the reform side that's not moving as expectations, it's pretty much there in the price. And let's not forget, rupee is closer to 56 and it's closer to its record lows. That said, a lot of rupee movement is really a function of how the flows pan out. And from here, like I said, the BOP situation doesn't look like it's going to deteriorate too much more. Thanks to a much weaker level on the rupee, imports have come off. Exports haven't gone up as much as they should have for a weak currency. But overall, the trade deficit seems a little lower. Capital inflows are coming in reasonably well. And with the prospect of a QE3 in US and the monetary easing across the world increasing, it looks like the capital flows will continue to sustain. So it's very difficult to see a significant deterioration in the dollar rupee level, and any upside should get sold into this rally. Let's also realize that a lot of exporters are not completely hedged as much as they would probably like to be. So I think on the whole, it's a pretty range-bound scenario with upsides getting sold.
Sure, but you know, funny, somewhere the market it seems to be taking too much heart from the fact that the trade deficit picture is looking a little better. But going forward, what's the guarantee that it will stay at a comfortable level? Because you're talking about QE possibly coming out of Europe, possibly coming out of the US, which everyone's saying could take oil prices to as high as $130 a barrel. Now, even if we do see large capital inflows into equities, do you believe that's capable of setting off a high oil bill for us?
The other factor that is there in this game is on the import side is, thanks to the rupee depreciation, a fair amount of import substitution has already taken place. If you look at the data over the last few months, while exports have come off on a sheer growth basis, and that's because of a slowdown across the world, imports have come off at a much bigger pace. So even accommodating for a higher crude oil price, imports in general seem to be a little lower, and gold has come off quite a bit thanks to the high prices, the dollar rupee movement, and also the high commodity prices on gold. So in general, the trade deficit does not look very alarming from here.
We also had the RBI's annual report yesterday, and they clearly stated that FY13 growth is expected to stay below trend. What's your sense as to where we can see that stabilize, and any targets that you have on inflation, which is likely to remain sticky according to the report at around 7%?
Yeah, we quite are in the same line as that. We see growth going at 6, maybe sub 6. The risks to growth are real. There's only so much that a consumption-led growth can take us to. Clearly, we need some more reforms. We need more investment-led growth, which clearly is not happening at this point of time. So growth will clearly stay muted. And inflation will stay sticky at around 7%, partly because monsoon has not been so good, so food inflation continues to be high. Like I said, a lot of growth is still demand-driven growth and consumption-driven growth. So inflation tends to be a little higher because demand is not coming off, and there's no large supply factor that's coming in. So overall, we are seeing inflation stay around 7%, give or take, which is still higher than the comfort level for the Reserve Bank. And core inflation stays high, so that's also another concern. and growth will stay about 6 or slightly below 6.
And Fani, just focusing on the fixed income markets, what's the range you expect the 10-year bond will trade at?
It's a lot depends on whether there will really be enough reasons for the RBI to cut. The reasons for RBI to cut will really be 3 factors: whether to see if inflation is coming off dramatically, which we don't see, if growth slows down even more from here, like I said, 6%, and that's pretty much there in the analysis. And if there is a serious change in either the fiscal situation or the reform situation. I think the third one is the biggest joker in the pack, whether we will really start seeing a fair amount of initiative from the government to start either controlling fiscal deficit or bringing in more capital flows. In the absence of these, it's difficult to see a repo rate cut happening anytime soon. And without a repo rate cut, bonds will stay in pretty much this range. A very broad range for the benchmark will be about 810, 820, 830 maybe. And even with a repo rate cut, it's very difficult to sustain a level that's way below 8 on the benchmark. So bond yields should stay in a 10-15 basis point range from here.
Most people we speak to have sort of given up a lot of expectation in terms of rate cuts coming through this year, against, I think, an expectation of something like 75 basis points more coming on the repo. Today the expectation is something like at best 25 basis points. What's the ING by share expectation?
We think about 50 for the rest of this fiscal. It's a little difficult call on the timing. September does not look very likely, but 50 basis points is there partly because at some place lower growth will start weighing on the policymakers, and if the government can get some of its act together, even if there's a very small increase in the diesel price, a little bit of initiative on FDI, or some more comfort on controlling fiscal deficit, I think that will kind of tilt it where the RBI will start focusing a little more on growth. And inflation does not see much of an upside risk, though it is sticky and at a higher level. And once growth starts weighing in, then I think there is compelling reason to look at a faster pace of cuts. So 50 basis points is what we're looking at for the rest of the fiscal.
Okay, thanks very much, Fani, for taking the time out and joining us with that perspective right here on Market Sense. Meantime, for the currency, it has come off its 2-week high. Let's take it straight to Manisha Gupta, who joins in with a perspective as to where it's headed and what the currency trading strategies are.
Well, thank you for that, Aman. As you pointed out, we were trading at a 2-week highs in the markets yesterday. We did touch 55.12 as well, but 55.40 on your screens right now, so the decline has been quite considerable. The rupee had been taking strength from the euro, which is still trading at around 6-week highs, and of course the government also coming out and relaxing the ECB borrowings norms for foreign investors to invest up to nearly $5 billion in India. So that had been supportive. But today the markets really have seen a change scenario. There has been mixed data coming in from US. Most of the high-yielding currencies have seen a bit of a decline. The Indian equity markets also trading on the lower side. Ditto is the case with the Asian equity markets as well. The feeling is that the mixed data coming in from US may not see stimulus coming in sooner as the markets were expecting. Also this week there were lots of expectations coming in from the European Union as well. But those meetings have happened and there is no concrete statement or announcement coming from there as well. Apart from that, you also have seen the Spain default or the bailout fears or concerns coming back into the markets, and that's another thing that's weighing onto the international currencies as well as the rupee as well. So buy calls coming back, Religare and Kshitij is what we spoke to, and both of them have a buy for the USD INR pair, with targets coming in around 55.55 to 55.75 as well on the higher side today.
All right, Manisha, thanks very much for coming in on the show with that check on the currency markets and also walking us through what traders believe the currency will trade at going forward. We've run completely out of time on Market Sense. From Avan, me, the rest of the team that put this show together, thanks very much for watching.